Hi there. So, welcome to the first video that I am doing on StockAnalytics.ai. I've just passed 10,000 subscribers. So, I wanted to introduce myself. My name is Rory, and I want to give you a bit of an idea of what I want to do with this channel, how we can traverse the market together, and hopefully we can get through the euphoria we see in the market now to a long-term path to growth with this huge opportunity that's AI and the various other technologies that are on the threshold of basically taking over the world. So, first of all, I'll just say my background is as a financial risk manager. Nothing on this channel is investment advice. What I will help you do is think in a macro way, hopefully bring things to your attention that you may not be aware of, and give you an overview of what's happening in the market. I'm also, as you may be able to hear, not American. I'm actually Irish. So I have an objective, I hope, or maybe a slightly more objective view of what's going on in the US and the markets. So hopefully that might help as well. I have worked in financial risk management for 25 years. I started off actually at the time of the dot-com bubble and worked as a programmer around that time. So I enjoyed the benefits of the dot-com bubble. It was brilliant working in a software house at that time. I was doing financial programming, and I remember it all too well, and it seems very familiar to what's happening at the moment. But I'm aware a lot of the people who subscribe to the channel are obviously trying to get the most out of the market, trying to get the stocks that are moving up as quickly as possible. Just also, and the purpose of these videos that I do on a value analysis method is to give a realistic feedback on those stocks. That doesn't mean in any way I, don't think that, like, go for it, basically. Just be aware that in the longer term, a lot of those stocks won't make it. That doesn't mean that there aren't the Amazons and the Googles and the longer term stocks that we saw come out of the dot-com bubble out there. They are out there, and that's something I want to help you to find, not over the next week or two or month or two, but over the years to come. Let me just bring up a image of the, hopefully by now, familiar psychology of a market cycle. So you could say back in 2011-12, we were in this sort of disbelief stage after the crash. Then we have been gradually going up here to the optimism, belief, thrill, and we are most certainly at the euphoria stage now in the market. So, what we need to watch out for is what the catalysts are for a crash, and then how to ride that out and make sure that we have preserved some capital to actually benefit from it when it comes around again, right? This opportunity over a decade or 2 decades of riding the AI wave. There's no doubt that the AI wave is huge. So I've started a new channel called StockAnalytics.ai News. Let me bring that up here quickly. I've just put up 1 or 2 videos on it. And I have done a video on the great wealth transfer. So basically, what we're talking about there is, and you may not be aware of this, but the private equity firms, a lot of the financial companies have a huge amount of dry powder at the moment. So they have up to $2.5 trillion in dry powder. And that tells you something. You might have heard that Warren Buffett has more cash on hand than ever before. They're waiting for the opportunity to deploy that cash and buy assets much cheaper than they are now, right? So that's the first thing. We'll talk about that a little bit more in a minute. The second thing is we did a video on will China win the AI race? Jensen Huang came out the other day and talked about how China might win the AI race, and that's a realistic possibility. And we need to talk about separating the narrative about AI from the reality. There's no question AI is a tremendous opportunity, but what the heads of these labs are telling you is just selling their own book. A lot of it can be discredited easily with a bit of logical thought. So we did a video on Elon Musk's $1 trillion payday, and then we're doing a video on the intersection between the US shutdown and Project 2025. So on a daily basis, I'll be posting new videos there, and it'll generally be the most talked about or interesting, I think, financial aspects of the news. So it's like a new news channel, but we'll do a deep dive on it, and that'll be something then I can come back to on the weekends and we can discuss in more detail. So let's first of all talk about wealth transfer. Let's quickly talk about what happened after 2008. So we had the run-in from the dot-com bubble to 2008, right? At that time, there was a few things happening. Passive investing had just started, right? A lot of the derivatives that are now in the market had obviously filtered in for mortgages like MBSs, etc., CDOs, collateral debt obligations were big at the time, and this is what kind of caused the crash. Obviously, interest rates and the control of interest rates is at the heart of all of this, right? So in 2020, in 2000, I was working as a programmer, and after that, I became a risk analyst. And in 2008, I was a trader for a company, and I watched the whole thing and participated in it. And I could see what was happening. And I want to tell you a little bit of the story about what happened after that, because people don't follow this stuff. People don't follow regulations and why things happen because it's boring generally. So let me just give you a quick and clean idea of what happened after 2008. So after 2008, the risky assets on banks' balance sheets were separated out, and basically they were handed over to what's called non-banking financial institutions. Those non-banking financial institutions now have all that risk, right? Now, at the time, I can't remember the exact numbers, but non-banking financial institutions were small enough. They made up maybe 10%, 20% of the market. Now they make up over 50% of the overall financial system. So everybody knows who's in finance that the next big problem could come and is more likely to come from the non-banking financial entities. People call them shadow banks than the banking entities. And the reason for that is when they separated out all the risky assets and put them into the non-banking financial entities, they don't have to regulate the non-banking financial entities because if they collapse, well then, private investors lose their money, right? So, there's nothing to worry about, right? Or that's the way it's supposed to be. But that's not really the reality of what's happened, okay? So after 2008, risky assets, risky trading, all this sort of stuff moved to the non-banking financial entities, and it just got worse. It got a lot worse because in the non-banking financial entities, there's no oversight. You can do whatever they want, right? So practices like what we saw even coming up to 2008 got worse, way worse. So previously to 2008, companies, private equity companies, various other companies would buy up companies. They would borrow the money. Remember, the interest rates were really low. And then they would buy up the company. They would put the debt on the balance sheet of that company. They would take out all the assets of that company, so basically bleed it dry. And then the market would bring that up, or they would do buybacks or whatever else to inflate the price, and then they would sell it back into the market, basically burdened with huge debt. Now, that's happened systemically across the board. So companies now are the new subprime mortgages. We now have subprime companies, and there's a massive amount of them. Between 20 and 30% of companies are subprime. And what that means, they're sometimes referred to as zombie companies, is that the biggest threat to them is actually inflation. Because if inflation goes up, then the Fed will have to put interest rates up. And those companies live off debt. So just like the US government is now paying $1 trillion a year to service its debt, those companies also have to service their debt. But if interest rates go up, they can't, and they get wiped out, and they default, and they collapse. And guess what? All those companies are rolled up into similar products that the subprime mortgages were rolled up into in 2008. So we basically got a similar situation. It's just not subprime mortgages, it's subprime companies now, all rolled up into all these products. Now, what's been happening with these products is quite remarkable as well. These products are issued by various non-banking financial entities. They're rolled out. The same non-banking financial entities can buy insurance companies. They can use the cash flows to purchase those products to make sure there's a market for them, to make sure that the price doesn't drop, right? So it's a bit of a house of cards, if you like, right? So it's being propped up internally, right? And the question now is, what's the catalyst to knock over the house of cards, right? So that's the great transfer. And I'll do a lot more in-depth analysis on that as time goes on. And as it starts to unfold, we'll talk about what's actually happening when it does unfold, right? So that's the first thing. Now let's talk quickly about the AI bubble, right? So during the week on Thursday, we saw Kimi K2 come out, Chinese model that basically competes with the frontier models, right? So this model was trained for, they're saying like $6 million. Look, even if it's $100 million, it's nothing compared to the capex that the major companies are putting into their frontier models, right? So we need to think about this. What are the disadvantages of closed models? The disadvantages, one is that they're harvesting all your data. And if you're a company or an enterprise, you don't particularly want all your data to be harvested by another company. It's just too much power you're giving them. The second thing is that they're restricted, or they can be, they might have an agenda. They might, basically um, not want to tell you this, that, and the other. Just the same way that Americans would warn about, you look into a Chinese model and ask it about Tiananmen Square. You can do the same thing with an American model and ask it about whatever the issue is at the time that there's a particular narrative about, and you'll get certain sanitized answers, right? So much better if you can actually spend 500 grand or £1 million as an enterprise on hardware and have a model like Kimi K2. You have all the weights, you have everything else. You can obviously unlock any locks that might have come with the model and have complete autonomy. It's entirely um, bound. There'll be absolute privacy with it. So Kimi K2 could be just reflecting back to January when the DeepSeek moment happened, and it was like a little pinprick in the AI bubble, and we got that $1 trillion sell-off. Could be another message to the markets that there is a potential deflation in that coming. And you had Jensen Huang's warning during the week that that China could surpass the US in the AI race. China has a few advantages. Energy is one. They have much more reliable energy sources. They have the ability to build data centers just on command. They don't need planning permission. They don't need to worry about their citizens. They don't need any of that sort of stuff. So they do have a lot of advantages as regards AI. But we need to think about it. If a model like Kimi K2 can compete with the frontier models, then the trillions of dollars that are being spent on GPUs could be, to make an analogy, like spending trillions on a calculator when the iPhone is around the corner. Basically, the calculator becomes redundant. We'll look back even in 2 or 3 years and go, that was a waste of money, right? So what really holds value there? So we need to start thinking on this channel about how AI is going to make money, not just be very exciting. I also am very excited about AI, but how it's going to make money in the long term, right? The same way that the internet made money in the long term for certain companies. That was generally around advertising, right? But AI will have obviously a lot of capabilities. It's already showing very good intelligence in science, in mathematics, areas like that. We've seen the AlphaGo moment, the AlphaFold moment. I think in biology it's going to make a lot of inroads, but none of this is happening at the moment, or it's happening slowly at the moment, right? So something that we want to be careful not to be over exuberant about. And I think maybe listening to Demis Hassabis is a good idea. He's a little bit more reserved because he doesn't need to raise lots of capital like the other guys, right? So that just gives us a better idea of what might be going on there, right? So while AI, no doubt, will revolutionize society, um, it will also introduce a lot of issues. If we even look at it logically, AI should be able to do a lot of the white collar work. And if it is, that will erode the tax base. And at the end of the day, who are companies going to sell to if there are a lot of layoffs, if people and their intelligence um, is no longer valued? Even if people don't lose their jobs, there will be a downward pressure on wages, you would think, because generally, the more skilled you are, the higher wage you would command because those skills were rare. Those skills are no longer rare. So that's going to change society. It's going to change the economics of how we value things. And that is going to mean that the consumer base is going to get eroded because, the middle class basically could potentially get flattened out by this. The key is, and hopefully we can help you do this on this channel as well, is to understand how to use AI effectively, what it can do and what it can't do. And that will change as time goes on, right? So just a few points there on AI. And then finally, I just want to talk quickly about the US government shutdown. So the US government shutdown, you can listen to that video again on StockAnalytics.ai news. There's good evidence that the US government shutdown at the moment is not similar to the shutdowns in the past. Remember back in 2000, I think it was 11, Obama was in power, and the shutdown actually meant there was a downgrade on the US government sovereign rating. If that happened now, that would be pretty catastrophic. So, and this is longer, this shutdown, than those previous shutdowns, right? The second thing to keep in mind here is how this shutdown intersects with Project 2025. If we look back over the year, it looks like a lot of the stuff in Project 2025 is actually being implemented. It's the Some of the goals in Project 2025 are basically to get rid of all these agencies and different bureaucracies, if you like, and consolidate them under the executive. So we're seeing some issues already, like for instance, the financial numbers, payrolls numbers, inflation numbers, and stuff like that that aren't being reported because the government departments are shutting down. Now, if we tie this into what's happened recently with the administration putting pressure on the Fed to lower interest rates despite what's happening with inflation, with somebody getting fired from I think it was the payrolls, basically for reporting a bad number, we can kind of see where this is going. Basically, there's going to be executive pressure to keep interest rates low no matter what's happening to inflation, right? And that's all very well, but that doesn't work because free markets don't work that way, right? So you could be in a situation where inflation is much higher. Even over the last couple of decades, many people would argue that inflation has been manipulated. The numbers have been manipulated by substitution and various other methods to keep the numbers low. Most of us feel that on a daily basis. But now we're in a situation where there's a lot of pressure to keep those numbers low, despite what's happening. A lot of things this year have been inflationary. The big beautiful bill has been inflationary. The tariffs coming into Christmas should be inflationary because US consumers will have to pay those tariffs on products, think Christmas presents, etc. So if we had inflation numbers, we'd expect inflation to be creeping into the market. Now, remember what I said earlier about interest rates. if interest rates were to go up, first of all, there's the sovereign debt, which is there's $1 trillion bill to pay the interest on US sovereign debt per year, right? That's a big issue, right? So no wonder there's a lot of pressure to keep interest rates low. But then there's all those zombie companies, right? And if we already saw over the last couple of months, we saw some of them companies start to fold, and we saw ripples in the financial system. The default rates are going up, so be aware of that. Those triggers are out there. Okay, so look, I don't want to go on too long in this video. We'll do more. We will dig into these issues in detail. Sign up, subscribe to, I know you're already subscribed to the StockAnalytics.ai channel, but subscribe to the StockAnalytics.ai news. We'll be rolling out a deep dive per day. I will continue doing the videos here. This is the first one, so hello to you all, and say hello in the comments. If you have any things in particular you want me to talk about, or you have any insight as well, let's start a conversation on the channel. Let's sort of form a community to guide our way through the next crisis and make sure that we all profit from the next growth phase. So thanks again.